So in your mind, is an L1 token more like a company, a commodity or money, or some weird fourth bucket that's more like a commodity money?
Yeah, I mean, some people would call money a type of commodity, right?
Yeah.
So, I mean, to us, again, it fits the literal definition, the explicit definition of money. It certainly doesn't look like a company. It doesn't accrue
Yeah.
value like a company. And so, whether it's a money, a commodity money, medium of exchange, it's clearly for us in that bucket.
Yeah. Dan, how do you think about this idea?
Yeah, no, I think a lot of that resonates with me. I totally agree that L1 blockchains are not companies. They're very clearly different, with the most notable example being a company is a single entity. And a blockchain is a network of different stakeholders that come together to actually form and operate the network, right? So, concretely, that means the validators who actually run the physical machines that come together, process transactions, come to consensus over the state of the chain. You have the token holders, which is largely split into two groups: the unstaked holders and the stakers. They have different properties and different risks and different cash flows that they're eligible to. And then for most chains today, especially on the L1 side of things, you also have infrastructure providers that play a very important role in the operation or the facilitation of the chain, right? So you can think of something like Flashbots and their transaction processing system on Ethereum, or Jito playing a similar role in Solana. You could also think about staking operators, like liquid staking operators as well, who take a cut of the activity that moves through the chain in the form of REV in return for providing a service. Like staking operators, let's say Figment, played a very important role helping people run these physical boxes, or even just liquid staking providers, like let's say Lido, plays a super important role in the facilitation of the network as a whole. So that's just like a very different dynamic than what you see with a traditional company, right? Where there's a single entity that is legally liable for the operations of the business, and the net assets after bankruptcy go back to the equity holders, right? Like there's these systems in place that make this one entity very responsible for what the operations of the business do. And so that's the core difference in my mind, and why you have to think a little bit differently about the value accrual side of things. Um,
Hmm.
I also agree that the assets fit the definition of money. I think that you're 100% right about that. Where I would contend with you, I think, is like how they're being used today differs from why they should be valued as money, right? Like paying for transactions, absolutely the case. But like, okay, if we look at what those transactions are, it's largely like, meme coin trades, or even just like real asset trades. RWAs are more and more coming on chain. NFTs in that bucket as well. And we have like lending activity across DeFi. And you contrast that to, let's say, something like, fast forward to an awesome end state world where like global trade is settled on chain, and you have oil trades between countries being settled on chain. If you get to that point, I 100% think that the money piece becomes very, very real, right? Like if you have these large nation state entities that are using this to settle massive transactions that are incredibly economically important to the success of that nation, it starts looking a lot more like something that's money versus like, the three of us on this call, like using it to be our medium of exchange, for example. And also on the payment side, it gets like really interesting, like what a medium of exchange for a transaction is. Jonah, you actually tweeted something similar to this the other day, but it was like, you can go to another country, right? I live in the US. I can go to Europe, let's say, and transact with my credit card. And I paid dollars and they received euros. All right. The merchant actually got what they wanted. I got to hold what I wanted. And there's something that happens in the middle there, but it's like not exposed to either side of the transaction, which I find to be really interesting. Like, what is actually the payment? So when I think about really what's like this money, like commodity, like value driver, to me, it's like really the store of value thing. Like, I want to use this vehicle to transport wealth through time. That's the most interesting commodity like aspect in my mind.
Okay, so I want to unpack a few things you said there. Maybe the last one on abstracting away the payment currency from the from the user. This is something I've heard a little bit, or more than a few times, and I think just to clarify, you're right. You can go to Europe, swipe your Chase card, and from your perspective, you're not actually holding euros because it's abstracted away from you. But the settlement, the currency of settlement between you and the good or service provider is euro. That is the unit of account. That's what they're charging you in, and that's what they get paid in. So it's really not. It's less of like a psychological thing. And from from how we see it, it's really more of a specific ground fact thing. Like that is the unit of account between, what you owe them and what, what they're selling the good or service for. So I think in the case of L1 tokens, whether it's today and sort of the current use case, the way people are using these things to trade memes or settle RWAs, whatever, or in the future, if people are buying and selling oil, it doesn't need to be that they are, the claim here is not that people are going to buy and sell off-chain goods and services with on-chain money. The claim is that they're going to settle on-chain goods and services, namely transactions, in on-chain money. And so that I think is sort of a key first principle. And then from there you say, in the case of L1 specifically, because blockchains scale so quickly, like transaction fees, the median transaction fee decreases probably more than 100% a year for the next X many years, right? So that is quite deflationary in terms of the effect that has on accruing monetary value. But when you look at these other use cases, right, which is like buying the token to stake it and earn a native yield, or to use it in DeFi, as collateral for a loan or as a liquidity pair, the supply of the token does not scale as demand for those two use cases of the token scales, right? The supply of block space and transaction capacity scales as the demand to use it scales. And every commodity, the golden rule of commodities investing in general is just like supply is the enemy of price. More supply is the enemy of price, right? And so, L1's really sort of unique in that, for payments, the supply side really scales like infinitely. On the demand side, though, for the SOV, or when you look at the SOV side, the supply really doesn't scale. I mean, ETH, inflates 0.5%, whatever a year. Solana 10%. Like it's relatively meaningless, or it's meaningless relative to how much the demand for these assets to use them as a store of value in DeFi and to stake for native yield scales year over year, 100, 200% year over year. So that's really where we see the meat of the monetary value accruing. But maybe we can step back and talk more about like why we're looking at it this way and why we think this is really the core of the bet that we're making when we buy a token.